Kia ora koutou katoa. Welcome to the second series of our series of deep dives on NZ IFRS 18. My name is Michelle Lombard. I'm the Director of Accounting Standards. And with me today, I've got Gali and Carly, two of my team members that will take us through some important concepts of NZ IFRS 18. Just some housekeeping rules. It's good to see everybody here today, so thanks for joining. I am going to ask if you have any Q&As, please drop it into the Q&A box. We will be answering as we go. And if we don't get to your questions, we'll try our best to cover some of them at the back end of the session. I always have to caveat this. We can't give accounting advice. We can only merely tell you about the principles of the standard. Okay. This webinar will be recorded today, and slides and the recording of this webinar will be available on our website shortly after this presentation. We try to put it onto our website within 24 hours. So if you miss anything or if you want to re-listen to anything, it will be available. It should be available tomorrow. And then it's always useful for me to just cover off who we are. So just as a reminder, we're the External Reporting Board, or we refer to ourselves as the XRB, and we're an independent Crown entity responsible for developing and issuing standards in New Zealand that covers off accounting standards, assurance and ethical standards, and then also our climate-related disclosure standards. Yes, with that, we will start this session. I just want to highlight that this is a deep dive into the grouping of financial information of financial statements. So this is a deep dive into IFRS 18. If you've missed the overarching high-level view of IFRS 18, that is available on our website. And Gali, you'll cover off in the next slide, but you'll go through that we have 3 deep dive series that you can follow. This is the second one of those 3. All right, thank you very much. I'll pass over to Gali.
Thanks, Michelle. Kia ora and hello, everyone. So let's start off by first taking a look at a few key facts about NZ IFRS 18. This standard is the New Zealand equivalent to the International Accounting Standard Board's IFRS 18. It replaces NZIS 1 presentation of financial statements when applied from 1 January 2027. Early application is permitted for those who would like to early adopt. As NZ IFRS 18 is a general presentation and disclosure standard, all for-profit entities that apply our standards will be impacted. Later on, we'll talk about some of the disclosure concessions for Tier 2 for-profit entities. NZ IFRS 18 introduces 3 sets of new requirements, which are shown in the dark gray boxes on this slide. In today's deep dive, we will cover the enhanced requirements on the grouping of information in financial statements. On our website, you can find the slides and recordings for our June deep dive on the new categories and subtotals in the statement of profit and loss. And you can also find on our website the event page for the upcoming deep dive in October on management performance measures. Now, before you hear more from us, we'd actually like to hear a bit from you. So we are now less than 18 months away from the mandatory date of NZ IFRS 18. And so we'd just like to take this opportunity to see where you are in your NZ IFRS 18 implementation journey. So we're going to run a poll. And if you could just hopefully you can see the poll. So if you can take the time to respond, that would be great. Going to close the poll in a few seconds. Just let give people a chance. Bye. I think I'll close it now. So you can see the results. So just over half have, or yeah, already close to 60% have started thinking about the implications of the new standard. 39% haven't started yet, and 4% already have an implementation plan in place. So that's great. But I think it's quite heartening and quite good to see that a lot of you have started thinking about this, the implication of the standard. So yeah, that's great, and it's good to know that. So thanks for participating in the poll. So coming back to the specific area of IFRS 18 that we're focusing on today. So this is the enhanced requirements and grouping of information in the financial statements. I'm going to first talk to you about the reasons for introducing these enhanced requirements. Then I'll talk a little bit about materiality judgments and the enhanced guidance in IFRS 18 on the roles of the primary financial statements and the notes. And then Carly will talk to you about the enhanced guidance on aggregation and disaggregation. And finally, she will discuss the requirements in IFRS 18 on the presentation and disclosure of operating expenses. So let's first take a look at why the International Accounting Standards Board, the IASB, developed the enhanced requirements for the grouping of information in IFRS 18. The IASB had heard from investors that information in financial statements can sometimes be so aggregated to the extent that useful detail is omitted. Conversely, sometimes information is so disaggregated to the extent that material information is obscured. This can happen when so much detail is provided that it can be hard for users to find the information that they really need for their decision making. Instead, IFRS 18 addresses these concerns by providing guidance on whether information should be presented in the primary financial statements, so in a more summarized manner, or disclosed in the notes. The standard also includes guidance on how to aggregate and disaggregate information so that the appropriate level of detail is provided to the users of the financial statement. There's also guidance in the standard on how to determine informative labels for items so that it's clear to users what these items comprise. I want to emphasize here that these enhanced requirements apply across the financial statements, so they are not limited, for example, to just the statement of profit or loss. For some of you, the enhanced requirements that we're going to mention today may already be consistent with how you are currently thinking about presentation and disclosure in your financial statements. But for some entities, these enhanced requirements might change what their financial statements look like. Overall, the requirements are intended to enhance your communication with your stakeholders by giving you the opportunity to refresh the presentation and disclosure of information across the financial statements. Before we take a look at the enhanced requirements on where and in how much detail to provide information, I just want to remind you that only material information needs to be presented and disclosed in the financial statements. NZIFRS 18 does not change the existing requirements in NZIS 1 relating to materiality, which requires considering the information needs of primary users of the financial statements. So the guidance around determining what information to provide is unchanged from NZIS 1. But now, NZIFRS 18 introduces guidance around where to provide material information. It does this through providing guidance on the roles of the primary financial statements and of the notes. This enhanced guidance, together with the existing materiality requirements, helps to achieve the objective of financial statements, which is to provide useful information to users. The ISB has developed a diagram to show how the materiality process interacts with the roles of the primary financial statements and the notes. There's a link to this diagram just at the bottom of the slide. I should mention here that even though the materiality requirements themselves are unchanged from NZIS 1, the enhanced guidance in NZIFRS 18 on where and in how much detail to provide material information arguably brings the topic of materiality to the fore. So implementation of NZIFRS 18 can actually be a good opportunity to really focus on your materiality judgments by thinking carefully about who are the primary users of your financial statements and what information they would consider material for their decision making. We also encourage you to think about who else in your organization needs to be part of the conversation around materiality, because it's important for the relevant decision makers to be on board with your judgments. And now I'm going to focus on the enhanced guidance in NZIFRS 18 about the roles of the primary financial statements and the notes, which determines where material information should be provided. So this slide gives you a snapshot of these roles. We'll go into each of them in more detail in the coming slides. You can also see in this slide what we mean by primary financial statements. So this is a new term to distinguish the 5 required statements, which are on the left-hand side of the slide, from the notes on the right-hand side. It's worth mentioning here the connection between the primary financial statements and the notes. So the existing requirement in NZIS 1 to cross-reference each item in the primary financial statements to the related information in the notes has been carried over into NZIFRS 18. In addition, NZIFRS 18 requires to disclose the line items in the primary financial statement in which the amounts disclosed in the notes are included where it's applicable. So this two-way linkage between the primary financial statement and the notes helps users' overall understanding of the financial statements. Let's now take a look at the roles of the primary financial statements. Feedback and research have shown that users pay more attention to the information presented in the primary financial statements and use it more frequently than the information disclosed in the notes. This is because primary financial statements give an overview of financial performance, position, cash flows, and changes in equity. Also, primary financial statements tend to be more structured than the notes, so that it's easier to use them to compare entities. The primary financial statements can also be used to identify items or areas where users might want to learn more or get more information on. So for these reasons, the role of the primary financial statements is to provide a structured summary of assets, liabilities, equity, income, expenses, and cash flows that are useful to users of financial statements in the ways that I have just mentioned. When thinking about this role of providing an overview, it's important to focus on understandability. So there may be a lot of information that you have decided is material, but not all of that information should be presented separately in the primary financial statements. Otherwise, these primary statements will become too cluttered, which would make it hard for users to understand what is going on. It's up to each entity to determine what information will provide an understandable overview for their users, and therefore which line items should be presented to provide a useful structured summary. Let's take the example of a restructuring expense. To decide whether to present a line item for this expense in the statement of profit or loss, an entity would need to consider whether doing so contributes to a useful structured summary of income and expenses. The information would need to help users in at least one of the following ways. First, separate presentation of the restructuring expense could help users understand an increase in the total operating expenses for the period. So it could help with giving an understandable overview of expenses. Second, the restructuring expense generally would not occur consistently from period to period. So presenting the restructuring expense separately from other expenses in the statement of profit or loss could make other line items more comparable to amounts presented in the prior period and to amounts presented by other entities, which would help users with their trend analysis. Lastly, when additional information about restructuring expenses is disclosed in the notes, separate presentation of the restructuring expense could draw users' attention to this extra information in the notes. Now let's talk in a bit more detail about the line items presented in the primary financial statements. NZIFRS 18 explicitly states that you do not have to present a particular line item if that line item is not necessary for the statement to provide a useful structured summary. This is the case even if a standard describes a line item as a minimum requirement. But if the information provided by the item is material, then this information must be disclosed in the notes. For example, you may decide that presenting the impairment loss on your receivables in accordance with NZIFRS 9 financial instruments is not necessary to provide a useful structured summary of income and expenses. So you might not present these losses separately in your statement of profit or loss. but you would still need to disclose those losses in the notes if they are material. NZ IFRS 18 allows for the presentation of line items and subtotals in addition to those that are specified by a standard. For example, NZ IFRS 18 requires presenting an operating profit or loss subtotal and certain other subtotals, but you may decide that an additional subtotal would provide a useful structured summary of income and expenses. However, certain requirements must be met in order to do so, as shown here on the slide. I want to point out that additional line items and subtotals must be compatible with the statement structures that are required by NZ IFRS 18. So you might recall from the June webinar that there are specific categories and subtotals that must be presented in the statement of profit or loss. Any line items or subtotals that you want to present in addition to what is required in standards must still fit within this mandated structure to preserve the ability of users to compare financial performance across entities. For this reason, you wouldn't be able, for example, to present a line item or subtotal that has some expenses from the operating category and some from, say, the investing category. So this slide and also the next one set out the mandatory statement structures that are specified in NZ IFRS 18 for each of the five primary financial statements. I won't go through these requirements in detail here, but hopefully these tables should be a handy quick reference guide for you when you need to remind yourself of those mandatory requirements. Moving on to the role of the notes, here you would provide users with material information necessary to enable them to understand the line items presented in the primary financial statements and to supplement these statements with additional information to achieve the objective of providing useful information to users. This includes this additional information includes information that is specifically required by a standard. For example, information on unrecognized contingent assets and liabilities as required by NZIS 37, or information about financial instrument risks as required by NZ IFRS 7. It also includes other information that you think is necessary to provide to the users of your financial statements, even if it is not specifically required by a standard. So this brings us to the end of the first part of our deep dive, which was on materiality and the roles of the primary financial statements and notes. To recap, the existing general materiality requirements are still there in NZ IFRS 18, and this is a good time to potentially refresh your thinking about what is material to users. And NZ IFRS 18 introduces enhanced guidance on the roles of the primary financial statements and the notes, which determines where to present and disclose material information. Depending on your current practice in this area, this might possibly lead to changes in how you present and disclose information in the financial statements. And now Carly will take us through the enhanced guidance in NZ IFRS 18 relating to the level of detail to provide in the financial statements. Over to you, Carly.
Thanks, Gali. So NZ IFRS 18 contains principles for grouping transactions and other events into the line items in the primary financial statements and the information disclosed in the notes. So just to summarize, you must ensure that items are aggregated based on shared characteristics and disaggregated based on dissimilar characteristics. And we'll talk a little bit more about characteristics shortly. You must then place these items in the primary financial statements and the notes in order to fulfill their roles that Gali has just gone through. So that is, consider what line items would provide a useful structured summary of your assets, liabilities, equity, income and expenses, and notes, cash flows, and what material information is required to supplement the primary financial statements and enable users to understand the line items. And finally, you need to group information in a way that does not obscure material information or reduce the understandability of the information presented. Now, the standard provides examples of the characteristics of items that you should consider. And some of these are shown on the slide here, with more of those in the standard itself. So for example, the nature of items, size, function, or geographical location would be characteristics to consider when aggregating and disaggregating items. So the more similar the characteristics of items are, the more likely it is that aggregating them will fulfill the role of the primary financial statements or the role of the notes. And likewise, the more dissimilar the characteristics, the more likely it is that disaggregating items will fulfill those roles. So as I will repeat a few times, the role of the primary financial statements is to provide useful structured summaries, meaning that the information presented in the primary financial statements is necessarily more aggregated than the information disclosed in the notes. Aggregated items in the primary financial statements must have at least one shared characteristic, but due to its summarized nature, the line items will also contain items that have dissimilar characteristics. And just a single dissimilar characteristic may result in information about disaggregated items being material. And that information must then be disclosed in the notes if separate presentation in the primary financial statements would not contribute to a useful structured summary. As you can probably tell, deciding how best to group information in the primary financial statements and the notes to provide useful information to users will require you to apply professional judgment. So we encourage you to engage in early discussion, I should say, with your auditors about your judgments in this area, as well as about the required extent of documentation to support those judgments. Now, I appreciate that that's a lot of theory and a lot of talk about principles to wrap your heads around. And so I want to provide a couple of examples just to help you see how these principles may apply in practice. Now, the first example comes from NZ IFRS 18, whereby a company has both non-financial assets and financial assets. Now, these types of assets are sufficiently dissimilar from each other to be presented separately in the statement of financial position. But the disaggregation does not necessarily stop there. The financial assets comprise equity investments and debt investments, and those two types have different characteristics because they have different measurement bases. So some are measured at fair value through profit or loss, and others at amortized cost. In this example, the company decides that disaggregating the financial assets based on those measurement bases, as shown here, would contribute to a useful structured summary of its assets. Now here you can see how the company may present these items in its statement of financial position. However, equity investments are dissimilar to debt investments, as each exposes the company to different risks. The company must therefore assess whether further disaggregation of this line item here is necessary in the statement of financial position, again, if it contributes to a useful structured summary, or in the notes, if this information is material. Now, please note that, of course, this is only an example, and different entities may come to different conclusions around what provides the most useful structured summary in the statement of financial position and whether disaggregated information is material and therefore would need to be disclosed in the notes. And of course, there may be other dissimilar characteristics that you would need to consider as well. So it may be that several iterations of disaggregation would have to happen. So you may decide that a particular level of aggregation is sufficient, but then you may do a bit more digging in your line items and discover that actually there may be some dissimilar characteristics there that you really need to tell your users about and make sure that that's disclosed in your notes. Now, the second example has been taken from the ISB technical staff's recently published near-final examples, illustrating how an entity may apply the requirements in IFRS accounting standards to report the effects of uncertainties in its financial statements. The examples use climate-related fact patterns. I just want to note here that these examples will be formally issued by the ISB in October this year and that no significant changes are expected. And in the meantime, you can view these examples on the ISB's website, and we provide a link to that website in the slide here. So here we'll discuss a summary of example 6, which illustrates how an entity may disaggregate the information it provides in the notes about a class of property, plant, and equipment, or PP&E, on the basis of dissimilar risk characteristics, if this is necessary to provide material information to users. So in this example, an entity owns two different types of PP&E classified in the same class, one whose use results in higher greenhouse gas emissions, and one that produces lower emissions. After considering its particular facts and circumstances, the entity determines that the two types of PP&E have sufficiently dissimilar risk characteristics that disaggregating information about these types of PP&E would result in material information. The entity reached this conclusion after considering some factors, such as the size of the PP&E's carrying amount, the significance of climate-related transition risks to its operations, and external climate-related qualitative factors. Now, NZ IFRS 18 also contains guidance on how to label and describe items. The ISB heard from users that in some cases, descriptions are not always clear or complete. So for example, entities may provide information about unusual income or expense items, but do not explain why they are unusual. Therefore, NZ IFRS 18 requires you to describe items in a way that faithfully represents the characteristics of that item. Now, to achieve this, you would provide descriptions and explanations necessary to allow users to understand that item. So for example, if you disclose items as unusual, you would have to provide your definition of what unusual is. The use of the word other to describe aggregated items or line items is fairly common. So for example, other expenses or other assets. Users do have concerns about this though, as it can be difficult to understand what these expenses include when no further information is provided. Therefore, NZ IFRS 18 discourages the use of the term other and will only permit it if a more informative label cannot be found. The standard provides guidance on how to find a more informative label. For example, if a material item is aggregated with immaterial items, then you could find a label that describes the material item. Now, as you can see here, if you can't find a more informative label, then you may use the word other, but you will need to use the most precise label possible. So for example, other operating expenses or other financial assets. You do also need to be aware that you may need to disclose some additional information about items labeled other. And this would be the case if you have an aggregation of immaterial items. Now here you would need to consider whether the aggregated amount is sufficiently large that users may reasonably question whether any material items are included in that amount. If so, then information to resolve that question in and of itself is material information. And so the standard contains examples of the type of information you should disclose to resolve the question. For example, explaining that there are no material items included in that amount, or you could even give an indication of the nature and amount of the largest item, while also saying that no items are material. Now you may be wondering what is meant by the term sufficiently large and whether the standard provides any guidance on that. The answer is no. You would need to determine what is sufficiently large based on your particular circumstances and also what you think your users would question. The ISB has developed a flowchart for determining informative labels and information for aggregated items, which you may find helpful. And so we've included a link on the slide here as well. Right, so it's time for another polling question. Now, I appreciate that I haven't given you much time to absorb what I've just said, but yeah, we'll just be interested to see what you think. Let's give a few more seconds. Okay, I think we'll end there. Great, so 51% say maybe, that's fair enough. You need to think a bit more about how these requirements would affect you. But I also see that 36% have said yes. So yeah, so the standard will obviously give you the chance to really think about what items are included in your line items and in your note disclosure, and really think about whether there are better ways to describe what's in there for your users to understand. Okay, so now Guiley has spoken about the role of the primary financial statements, which is to provide a useful structured summary of assets, liabilities, income, expenses, equity, and cash flows. And we've also now just talked about the principles of aggregation and disaggregation. So we bring those aspects together to discuss the presentation of operating expenses in the statement of profit or loss. So NZ IFRS 18 requires you to present operating expenses in a way that provides the most useful structured summary of expenses. To do so, you would aggregate your OPEX using the characteristics of the nature of expenses and their function within your organization. Now, the terms nature and function will be familiar to you from NZ IS 1. But before we go any further, I do want to remind you what we mean by nature and function classification and what information each of these provide. So a nature classification provides information related to the nature of the economic resources consumed to accomplish an entity's activities. So examples of that would include information about depreciation or employee benefits. And a function classification provides information about the activity which the consumed resource relates to. So a common example of this would be the cost of sales line item, which combines expenses relating to production and other revenue generating activities, such as raw material expense and depreciation expense. So you can choose to present your operating expenses using either the nature or function classification. However, NZ IFRS 18 also allows you to apply a mix of nature and function classifications, as this may be the best way for you to provide the most useful structured summary of your expenses. And that is really the overriding consideration. Therefore, some of your line items may be aggregated on the basis of the nature characteristic and others based on the function characteristic. But please note that any individual line item must only include an aggregation of items based on one of those characteristics. So NZ IFRS 18 does provide some guidance on how to determine which characteristic to use to provide the most useful structured summary. And that I've listed here on the slide. But ultimately, you must think about what the users of your financial statements and what presentation of operating expenses would provide useful information for your users' decision-making, and also how this may align with how you're managing your business internally and with other entities within your industry. So here on the slide, I'm just showing you an extract of an ISB illustrative example, which shows a mixed presentation of operating expenses. So in this example, the entity has decided to aggregate most of its operating expenses based on the function characteristic. And this is based on how the business is managed, how it reports internally, and the standard practice within its industry. However, it has decided to present a separate line item for goodwill impairment loss, as an allocation of this expense to different function line items would be arbitrary. Now, as you can see in this example, there's only one line item that has been presented based on the nature characteristic. Some entities may have more of a mix, to the point where the same type of expense is presented in both function and nature line items. For example, an entity with a cost of sales function line item may include some employee benefit expenses, and it may also present a separate employee benefits line item for those expenses not related to the cost of sales function. So in cases like that, it would be important to label the line items in a way that clearly identifies what is included in them. So an example of a label like this would be employee benefits other than those included in cost of sales. So that's an example of a line item label, although quite long, that could work in this situation. So I'll move on to the disclosure of expenses by nature when presenting certain line items by function. But before we take a look at these requirements, I do want to point out here that Tier 2 entities do not need to apply the requirements that I'm going to discuss on this slide here. This disclosure concession is included in the recently issued amending standard, which is called RDR concessions NZ IFRS 18. This can be found on our NZ IFRS 18 webpage. The amending standard will also include disclosure concessions related to management-defined performance measures, which is the topic of our next webinar. So back to disclosure of expenses by nature. So the standard contains requirements for the disclosure of expenses by nature when presenting one or more line items by function, as I mentioned. Presenting operating expenses classified by function can provide useful information to users, but can also make it harder for users to understand what these line items include. So information about the nature of expenses makes it easier for users to forecast future operating expenses and enables a clearer linkage between the information in the statement of profit or loss and the information in the statement of cash flows. Therefore, if you present one or more line items by function, you must also disclose the amounts for certain expenses by nature, as shown on the slide here, in a single note. So please note that the amounts disclosed do not need to be the amounts recognized as expenses in profit or loss. They may also include amounts recognized as part of the carrying amount of an asset. So an example of this would be amounts for depreciation included in the carrying amount of inventories. As a separate disclosure, the standard also requires you to disclose a qualitative description of the nature of expenses included in each function line item, so that users can gain an understanding of what types of expenses are included in those line items. Now, this slide here sets out an example of the disclosure of the 5 specified expenses by nature that I've mentioned on the previous slide. As you can see, each line item that includes the expense is disclosed here. If any of these amounts have not been recognized as expenses during the period, then you would need to explain that, and you would also need to identify the relevant assets. And again, this example is an extract from an ISB illustrative example that you can find via the link on the slide here. So that brings us to a recap on the aggregation and disaggregation principles that I've just talked about. So please remember that aggregation is based on shared characteristics and disaggregation is based on dissimilar characteristics, and that you must always disaggregate information whenever the result, or disaggregate items, I should say, whenever the resulting information is material. And that can be in your primary financial statements or in your notes. Again, coming back to the role of the primary financial statements, which is to provide a useful structured summary. And also remember that the use of informative labels is necessary, so that you'll need to think about if you can find a more informative label than other, then you must do so. Then operating expenses, in summary, present based on the nature or function characteristic or a mix of both. And you would need to disclose some information about nature expenses if you present some line items by function in your statement of profit or loss. And as I've already mentioned, we encourage you to engage with your auditor on judgments around the grouping of information, as your financial statements may end up looking different compared to when they were prepared under NZIS 1. We also encourage you not to apply a checklist approach or imitate other entities beyond what makes sense from an industry perspective. For example, when thinking about whether to present your operating expenses by function, nature, or a mix of both. And there we are. So that closes off the discussion on the main requirements in this topic. Now, we do appreciate that there's been a lot of information given to you here, and you will need some time to absorb it. We know that examples can help a lot, and therefore we intend to share more of those with you when they become available, either through the IASB or if there are any early adopters willing to share their experiences. And I see the poll's already running, so that's good. Okay, yep, I think we can close it there. All right, so quite an even spread among the three. So as I've mentioned, we will look at providing more examples where possible over the next few months, and also providing opportunities for preparers to come together and share their insights and experiences. And Michelle will mention a bit more about our upcoming event later on. But with that, I shall now hand back to Michelle.
There we go. Thanks, Carly. There you go. Yes, Carly and Gali has both taken you through some of our new requirements on IFRS 18. I think it's quite useful, these deep dives, because it allows us some more time spent on aggregation and disaggregation. And with polling question 3, we do appreciate that feedback as to what additional information would be required going forward. The team has been hard at work in creating some new materials and additional implementation support to help you understand and come to grips with what IFRS 18 means for you. So do go onto our website. We've got quite a lot of information there. I'm going to highlight the fact that we do have the IFRS 18 on the 18th alert that comes out on the 18th of every month. The idea of that alert is just to make you aware or put a spotlight on something of the standard so that you're aware what these new requirements might be, and it just breaks down the standard in chunk size or bite size materials. We also going to highlight, or I also want to highlight, there's a one-page fact sheet as to what IFRS 18 is about. So this was a deep dive session. I'm just highlighting that. There is overarching webcasts, etc., on our website if you wanted to just go back to the overall or holistic view of IFRS 18 and what it needs to achieve. I also want to take the opportunity to just to say, for the aggregation and disaggregation rules that Carly just mentioned, it's for me, for IFRS 18, that's probably one of the most useful changes to highlight. The reason for that is it actually forces us to just refresh our financial statements and think about the users up front. And Gali mentioned the fact that materiality and the users haven't really changed with these new changes in IFRS 18, but it does bring that to the fore. It allows you to really think about who the users are of the accounts, and it allows you to think about how is this information going to be used by those users, those primary users of the accounts. And then that flows into how am I going to structure my financial statements as a communication tool. So I guess do take the opportunity to think about these rules, and very similar to what we had under IAS 1, but definitely more examples are included in IFRS 18. So highlighting that. All right. We did mention that we do have a community of practice that we are running. It's on Thursday, the 21st of August. It's in Auckland. It's an in-person session. And basically what our intention with this session is come along and come and talk about your experiences with other practitioners or other people doing the doing. It's really recommended for our finance managers or financial controllers, the people that are going to implement IFRS 18 into the organization. How are you thinking about it? What are the challenges that you're experiencing? Or actually, I'm just starting now learning from other people. What are their challenges, etc. So the intention of this session is definitely not for us to information dump. We're not going to do a session on IFRS 18. We're going to get people together that is doing the doing and learning from your experiences, creating a community of practice of how are we learning from one another in this. So I really do hope to see some of you on there, or some of you in person. And if it's successful, or if you think it's useful to have it in a different location, let us know and we'll try and organize that. This is a session in Auckland on the 21st of August. Then when I think about IFRS 18, I just wanted to highlight these key considerations. I think practically what do you need to know out of all of our sessions is probably the same message, and we're going to remind everybody every time. But basically, if I think about IFRS 18, you need to understand that the financial statements might look different. It really depends case by case, and it depends on how are you taking the changes in IFRS 18, how are you going to take this forward in your financial statements. We can't emphasize the second bullet point enough. Engage with your auditors early. There is transition processes that need to happen. There is consideration as to how your financial statements might look, and engaging with your auditors early on that allows cost savings, I think, on everybody's part, and everybody then does that. You don't have to have a flurry of activities when you actually have to report. It just allows better planning for all involved. We have mentioned this before, but ensuring the appropriate level of management is involved in the decision-making processes. Your financial statements might look different, but in order for it to look different, you need to make sure that the right people knows about this. Make sure that you know if you're thinking about framing up who the users are of the financial statements, what would be material for them, and therefore we are making these changes to the financial statements. Making sure that those charged with governance or the right SLT members or across those changes are really important. Let's not surprise people at the back end when you want them to sign off on their accounts. Always want to remind everybody that IFRS 18 is mandatory on the 1st of January 2027, but there are comparatives that must be restated. So what that means is when you are preparing your comparative information for the year of 2027, for example, that means the comparative period will be 2026. The requirement in IFRS 18 is that you do prepare a reconciliation between the subtotals in your P&L in terms of every single line item in your P&L based on what you had under IAS 1 compared to the new structure that you have under IFRS 18. So highlighting comparatives must be restated, and you need to show a reconciliation on how you go about that. And then lastly, which encapsulates all of these things that we have spoken about the whole time, is the application of significant judgments. Making sure that you know that there are significant judgments that includes identifying who your primary users are. It does include how are you going to structure your financial statements going forward. And then, yes, take the opportunity to refresh financials to make it as applicable as possible. We've got a few questions that's come up during this session, so I might just throw that to Carly. First and foremost is the question is, most entities in New Zealand has a mix and combined structure of nature and function requirements. Oftentimes we don't see the regulator being strict on that, which we're not the regulator, so that's not with us. The question is, how strict are the IFRS 18 requirements in this regard? So having the combination of nature and function, we have covered that off a bit, but you can just speak about that. And what is the disclosure requirements that's needed if you have both?
Okay, so NZIS 1 did not permit a mix of nature and function, which is maybe where the question around what the regulator is doing about people who still provide a mix. But with the advent of NZIFRS 18, NZIFRS 18 does explicitly allow you to present a mix of line items based on nature and function. And that's really because presenting a mix of nature and function may give the most useful structured summary of your expenses, which is maybe why quite a few people have been doing that in the past, because how else can you do it if there may be a line item that it might be arbitrary to allocate to function line items, but some of the function line items may be necessary to provide the most useful information. So, so that issue falls away. The standard does contain some guidance on how to determine which one to use, whether it should just be function, whether it should be nature, whether it should be both. And that really requires you to consider what your users want to see, how you internally manage your operations, what other entities in your industry are doing as well, so that users can compare information more easily. And in terms of disclosure, if you present function line items, then there will be some disclosure required of items by nature, but only on those 5 specified types that I mentioned previously. And again, if you present by function, you would also need to just explain a qualitative explanation on what is included in those function line items, or what types of expenses are included in there.
Right. Another question that's come through, Carly, I'm going to throw it to you as well. Sorry, Carly, not yours yet. What are your thoughts about whether related party payables and receivables should be separately disclosed in the primary financial statements from third party payables and receivables? What do we see in practice, and do we think it's going to change under IFRS 18?
So separate presentation of related party payables and receivables. I can't recall in IS 24 if there are any specific requirements around separate presentation. If not, then it comes back to, again, what is material information? It may very well be it's material information because users need to know about these related party balances. Are they quite large? I mean, that really depends on your particular circumstances. Again, you may decide that presenting related party payables separately from the other payables in your statement of financial position doesn't really give a useful summary of what assets and liabilities you have. But again, then it comes back to what is material. And if it is material information, then you'll still need to disclose that information in your notes. So.
Yep, that's right. It really just depends. A comment that just came through is there seems to be a lot of subjectivity or subjective judgment in how we aggregate and disaggregate in the standard. Are we understanding this correctly? I think that's exactly the example. That's exactly the key message today. There's a lot of subjectivity, and I guess if you start off by understanding the users of the accounts, then you probably getting it right, because then you are applying your judgment as to what you are disclosing where or presenting where. So yes, to that person, agree with that summary.
And I just want to, sorry, Michelle, I just want to add that NZ IFRS 18 is developed in order to give users more, or to give users useful information. So, but it also helps you as a preparer to sort of enhance your communication of what's actually going on in your particular organization and communicating that to your users. So that's why there is a lot of judgment, because it is very much, what is the information that's important there for you.
Yeah, I think we keep on saying refreshing your financial statements, but I guess if you think about IFRS 18, one of the reasons that IFRS 18, or one of the things that's part of IFRS 18, is the consideration of there has been multiple accounting standards that has come out over the course of the last few years. If you think about leases and revenue standards and insurance standard, etc., and all of this has sort of compiled your income, your financial statements quite significantly. So IFRS 18 is really a opportunity where you can stand back and actually think, oh, there's a lot in here. What is key for my users' decision-making process, and how am I communicating that information to them? So that is why there's so many judgments or allowance of that, is to really apply your judgment in that. There was a question that I just wanted to double check. It says, if we adopt early, so if you adopt IFRS 18 early into FY26, do we avoid having to restate comparatives? Oh, unfortunately not. I'm sorry. I'm sorry to tell you that. No, there's no workaround on that. Wherever you're going to adopt IFRS 18, the comparative period is where you're going to have to do a restatement, and you're going to do a recon per line item in your P&L. I'm sorry to tell you that. All right, I think I'm just quickly checking Q&As if there's anything else that I've missed. I've answered this one live and before. Yes, I think those are the main questions. I hope I have covered off everything, because we also have people just answering directly. So I think we've covered off everything. Okay, on that note,
sorry, Michelle,
Carly?
I just want to, just wanted to clarify my response on the related parties and payables and receivables question. Now, I did mention that I wasn't sure if IS 24 specifically requires any presentation of line items, but I do just want to clarify that even if it did, you do still look at NZ IFRS 18 and decide what gives you the most useful structured summary. So that principle does basically override the minimum requirements and other standards. So just want to clarify that. Thanks.
No, that's perfect. Yes, IFRS 18 sort of allows you to use your judgment in determining what is material, and then you start going into applying other standards. All right. That takes us to the end of the session. I'm going to highlight that we've got web pages full of information. Follow us if you want more information, or get in touch if there's anything more that you need information on. All right. Have a lovely day, and yes, we'll see you soon. Thanks. Bye-bye.